Hi and welcome to my channel. Thanks for subscribing. This will be the first video in a series of videos on level 1 of the Chartered Financial Analyst course. We start our course with the topic of corporate finance and equity. As I said, this is the first video, and I give here in this slide a short introductory about myself, my qualification and experience. So the topic of corporate finance, as you can see, is divided into 3 parts. Actually, it is only 2 parts, corporate finance and equity, but equity is covered in 2 sections. The corporate finance is mainly about investment in capital asset and about financing this investment and the cost of capital and the level of debt indebtedness of the company, which is called leverage. The equity is introductory level, which introduces the reader to the structure of the market and the indexes. But before going into each topic in the table of content, I would like to start with a central concept in finance, around which I believe personally that the whole CFA course is structured. This is the concept of value. We are trying to assign value to each asset. To explain this idea, let us take a simple example of a building that is rented out for $150,000 and was bought years back for $3 million. By dividing the cash I received, which is $150,000, by the amount I invested, the initial outlay, I get a return of 5%. Let us now rearrange this formula and get the value. So simply the value equal, or the required rate of return, equal the amount of cash I received divide the investment I made at the start of the project, or the value or the purchase price of the asset will give R. This might look simple for a CFA course, but it represents the backbone, in my opinion, of finance. This simple idea is behind complex calculations such as the weighted average cost of capital, the capital asset pricing model, the net present value, bond yield or the value of the bond, or even a value of a stock or a share of the company, and many other valuation, including valuing a company for merger and acquisition. By arranging this formula, let us rearrange it again using simple algebra. We find the value equal the cash I received divide the required rate of return. What I did, I just rearranged this formula. V equal cash I received divide the required rate of return. So from mathematical point of view, if you are dividing the cash you receive, 150,000, by a figure higher than 5%, you will get a lower value just from mathematical point of view. Now you are dividing by 10%, for example, instead of 5%. Definitely you will get a value less than 3 million. So the higher the required rate of return will be the lower the value. Now, let us assume that the owner now asks for 10% instead of 5%. That means we are going to divide whatever cash we receive here by a figure that is higher than 5%. So a figure is higher than 5, the value will be lower. From, again, mathematical point of view, it will give $1.5 million. But now, let us assume the investor or the owner of the building, instead of 10%, he asks now for just 6%. In this case, the value will be 2.5 million, which is higher than 1.5 at 10%, but lower than 3 million when the rate is 5, because 6 is higher than 5. So we can safely claim that the higher the required rate of return, the lower the value. Now, Normally we see such shape in our studies that says if interest rate drops, the value of the bond goes up, and if the interest rate rises, the bond price will go down. That is, there is inverse relationship between interest rate and the value of any asset, including the bond. But this looks very complicated for a student. They might not understand it and will just memorize it. Let us take simple calculation. If a value of 50, I receive cash 50 and the required rate of return is 5, I'll get $1,000. Now, instead of 5%, I'm asking for 10%. That means the 50 divided 10 definitely will give a value lower than 50 divided 5, which will give a value of 500. So, if the interest rate goes up from 5% to 10%, the value will go down. Interest rate went up. This is from mathematical point of view. But what is the economic argument in favor of this calculation? Is it just mathematics dividing by more amount or less? No. Let us see an example by asking this question. During time of high interest rate, such as the time now we are experiencing September 2023, the bond, stocks, and all other assets decline. Why? Let us give a simple example. Assume a bond issued for $100 and pays 4%. This 4% means $4 annually. I bought it for 100 and I get $4 annually. Let us assume that the interest rate has been increased by the Federal Reserve to a level of 8%. Now, why should I buy this bond and get 4% while I can go to the open market and buy a bond that pays me 8%? So we must get also 8%. The fair value of this $100 should give a return of 8%. We can't change the $4. We can't change the 4% because these are fixed figure as per the contract of the bond. The bond is in effect a contract between a lender and a borrower. A borrower is a company that issued the bond, and the lender is the person who bought it for $100. There is a contract between them that the borrower is going to pay the lender 4%, which is $4 annually. Now, as I said, the interest rate in the market is 8%. I will never buy this unless this 100 value goes down to a level that gives the investor the 8%. The only way to do this is to decrease the value. So the price should go to a level that gives the $4 a percentage of 8%. This is simply 4 divided 8%. 4 divided 8%. The value is now 50. The bond value will go down in the market to $50, so that the $4 I receive annually equates to 8%, similar to the market. This graph shows the interest rate for a decade, or for, let us say, 4 years actually, from 2019 to 2013. If you remember, in 2020 there was a pandemic, COVID-19. The interest rate went almost to zero because the Federal Reserve followed what is called quantitative easing by making the interest rate close to zero, and borrowing is now cheaper. So prices of the stock went up, bond went up, all assets went up because of the crash. Then in 2022, the Russian army invaded Ukraine. That led to high oil prices, which led eventually to very high level of inflation. To fight or to tame the inflation, the Federal Reserve started to hike the interest rate to a very high level. As we said, higher level of interest rate, stock will go down, bond will go down. That is the logic behind my formula. As I told you, it is very central concept in finance. Let us continue with our central concept, that is, the value of any asset depends on two factors, the cash flow or the cash stream and the required rate of return. Normally, the cash stream is well known, as in the building. It is rented for 150,000. We know it in advance. Or in some cases, we estimate 5 years or 10 years cash inflow, and then we use a required rate of return of 2, 3, 7, 8, 20%. How to do that? That will be the whole course. Level 1, level 2, level 3 is always trying to answer this simple question. What is the fair required rate of return? It is all about risk. But before going to risk, I want to mention here a golden rule, as I call it. A value of anything depends on the cash it generates and the required rate of return. So if the required rate of return is high, the value will go down, and vice versa, as we said. Now, if the required rate of return is 3% or 12%, the value will differ. This will give very high value of the asset, and this will give lower value of the asset. It follows from this discussion, the lower cost of capital, the higher the value of the company. So we know that the main role of the finance manager is to maximize shareholder wealth. To do that, managers must strive to reduce the weighted average cost of capital so that the value of the equity, that is the share price, will go up, thus achieving their role in maximizing shareholder wealth. But how company could minimize or reduce the cost of capital? That is a big question. We will answer it through the whole series of the videos. But for now, let me stress one concept. That is, risky projects require very high rate of return to compensate investor for shouldering such high risk. Because if I have two projects with similar risk, I will choose the one with higher return. That means the higher the risk, I will assign very low value so that I get a very high return. To prove this further with some complicated example is the corporate governance. We know the corporate governance is a system of managing the company so that we reduce the risk. Information provided by a company that have a very high or sound system of corporate governance, the investor in the market will rely on this information. Information produced by such sound corporate governance will be very reliable. We know from the International Financial Reporting Standard, specifically conceptual framework, it states that one of the characteristics of useful information is reliability. So, if the information is reliable, because the corporate governance that produces this information is very strong, then this will lead to lower information risk. There's so many risks in investment, but the information risk is one of them. By having a very good corporate governance, we lower the information risk and lower the required rate of return. Hence, we create value because the value will go up now that the risk is very small. I want to mention here one important takeaway from this video, that value equal cash divide required rate of return. This is crucial and central. I will keep this formula in all the slides in the other videos as well. Therefore, never forget that the value equal cash divide required rate of return. In our next video number 2, we'll start on the table of content with the corporate governance, what it is, and we'll explain it further. The most important part of corporate governance, let me say it here in preparation for the next video, the video number 2. We all understand that corporate governance is rules, regulation about board of director, how many board should be there, and how many times they should meet. Manager should do this, they should not do that. What all this about is about managing the conflict of interest between many stakeholders. Who are the stakeholders? Anyone who has a stake in the company is a stakeholder. Shareholder is number 1. They have a big stake. Lenders, banks, and bondholders have a stake in the bank and the company. Customer, suppliers, employees, all these groups have a stake. Their stakes are conflicting. That means one stake will be at the expense of the other. If we increase the interest of employees by increasing their salaries, this will reduce profit, which will go against shareholder interest. We will look into this in the next video. So you should subscribe so that whenever I send a new video or publish new video, you get notified and you will have the whole series. Thank you.